Hey there, welcome back to the channel. My name is Christina, and I spent over 15 years in real estate sales and mortgage lending. And I've helped my clients on both sides of the transaction. On this channel, I talk about specifically how you go through the loan approval process with a lot less stress, a lot less headache, and get the keys much quicker. In this video, I'm going to talk about how to pre-qualify yourself, right? Actually calculating your mortgage pre-qualification. In a previous video, I talked about why this step is so important for you to do for yourself before you talk to the lender. And again, in this video, we're going to go through the actual steps of pre-qualifying yourself so that you don't have any surprises when you go and talk to the lender. So without further ado, let's get into exactly how you go through this process. Now, first thing that you need to understand about pre-qualifying is that number one, we're going to be calculating what your monthly loan amount will be. Okay, that's what this process is going to help you do. Now, you're going to need a calculator, pen, pencil, at least one, either pen or pencil, but definitely you'll need a calculator to help you go through this process. You will need to know what your income is, either yearly, monthly, or by pay period, and I'm going to show you how you can calculate that out. Okay, so let's talk about your income first and foremost, right? Your mortgage is broken down into a monthly payment, so you need to know what your monthly income is. And if you don't know what it is, I'm going to show you how you can get to that number. Now, we're going to focus on W-2 income earners because that's the majority of individuals that are going to be looking for a mortgage loan approval. It doesn't mean that you have to be a W-2 earner to get approved. It just means that we're focusing more so on that calculation. Now, if you are self-employed or if you're a 1099 earner, the thing you have to realize, the difference is that when you're self-employed or 1099, the lender is looking at your net profit to determine what your income is versus W-2 earners. The lender looks at gross income, which is the income you earn before taxes or any deductions are taken out. So in some instances, W-2 earners sort of have an advantage in that area. But if you're self-employed, 1099, and you report on a Schedule C, the lender is going to look at your net profit. Now, unless you're paying yourself through a payroll service, which could make you a W-2 earner, but if you're just self-employed or 1099, not paying yourself through payroll, then your income would be looked at from the net profit standpoint. That's just a little side note. Now, let's go on to step one. We're going to talk about the W-2 income lender calculation. Again, I'm giving you the perspective of how the lender is going to look at your income, how they're going to calculate things so you can do this for yourself. All right. Now, first things first, we need to know what your gross income is, and I recommend that you pull that from your pay stub. Okay. Step B, we're going to calculate your monthly income. Now, if you're paid weekly, then take that gross amount, right? The amount that you earned before taxes and deductions, and multiply by 52 weeks if you are paid weekly. If you're paid every 2 weeks or bi-weekly, you're going to take that gross amount and multiply it by 26 weeks. If you're paid twice a month or semi-monthly, you're going to take that gross amount and multiply it by 24 weeks. And so this is how you would get to your yearly income, right? So this calculation that I just went over, whether you're paid weekly, every 2 weeks, or twice a month, this calculation is going to give you the yearly amount that you're paid, okay? So once you get that yearly amount, you're going to divide that by 12 months. And this is going to break down your income into monthly amount, okay? So again, get your gross income from your pay stub, calculate your income for the year by multiplying your weekly pay or bi-weekly pay or twice a month pay by the numbers I put on the screen. And then you're going to take that dollar amount that you get and divide it by 12 months. So this is the first step. Once you've done that, right, go on to the next step. Here we are at step 2. Now we're going to talk about your allowable mortgage payment. So when you apply for a loan program, and this, I have to say this is a general way to come to what you pre-qualify for, because each loan program is different. They have different percentages, which we'll go over in just a moment. But this is a way to give you an idea of where you stand. So in this step, we're talking about what your loan program will possibly allow you to have in a mortgage payment. Okay. And so let's get into how we get to that. So what I'm talking about here is how much of your income will be allowed for a mortgage payment, right? So the way they determine that is by percentages. And as a general rule, you can multiply your gross monthly income, which we just found in step 1, by 33%. So take your gross monthly income from step 1 and multiply it by 33%. Okay. Again, your loan program may allow a larger or a smaller percentage of your income, but this is a good middle ground, 33%. Again, this is just giving you a general idea. Okay. So once you do this step, let's move on to step 3. All right. Step 3 is your monthly allowable total debt. Okay. Let me say that again. That was a lot of words. Your monthly allowable total debt. What amount will your loan program allow in total for debt payments? Okay. So how much of your income can go towards debt? This is another step in pre-qualifying you that the lender is going to look at. Step 2 was about how much they're going to allow for a mortgage payment. And step 3 is how much they're going to allow in total debt from your income. So what you would do is go back to step 1 again, get that gross monthly income and multiply it by 45%. Again, have to restate this. This is a general idea. So your loan program may allow a larger or smaller percentage of your income to be used for total debt. It's really going to depend on the loan program you have. So this is a general idea of how much debt you can have in total for the loan program, right? So this is a general idea. So once you've calculated this, your gross monthly income multiplied by 45%, this gives you a general idea of how much total debt they will allow you to have. Okay. And I'm going to go into now your current monthly debt, right? And help you understand a little bit of what the thought process is behind allowable debt. Okay. So what is your monthly total debt expense? Okay. Now, when the lender is looking at your information, they're going to pull credit report, and they are going to, from your credit report, see what your debt obligations are. They're going to look at your minimum payments to come up with a total of what your current debt expenses are. Now, you only include in this calculation loans, credit cards, lines of credit, payments for child support, and alimony if you pay it from your income, right? Not receiving it, but you pay it. You would include that. Now, some exceptions could be debt that is almost paid off. So if you have a debt that has less than a year remaining on the payments, it's possible that the lender will not count that debt against you. So just kind of keep that in mind. Take a little note, write that down, that if you have a debt that has less than a year remaining on it, the lender may not count that in your debt to income ratio, right? They may not count it in your current monthly debts. And you can definitely take a note and ask the lender hey, are you going to include this debt? Can this debt be excluded? Because I have less than a year to pay on it. Okay. So that's just a little tip. But what is your current total monthly debt expense? That's important to know in this step. Okay. Now, if you are currently a homeowner or a property owner and you have mortgage on the property, you will need to include any existing mortgage payment unless you're selling that property to purchase the new property, right? So if you have a current mortgage and you're planning to sell that property in order to purchase the new property, you can exclude an existing mortgage that's going to be disposed of or sold to purchase a new property. But if you're keeping the existing property and trying to get a mortgage for another property, the mortgage payment will have to be included in your total debts. Okay? Because again, any loans, credit cards, lines of credit, payments for child support, alimony, right? So we can't forget loans include mortgage loans. It also includes student loans. Okay? Now, you can pull your own credit report and verify what your minimum payments are showing up as. If just as a checks and balance, go pull your credit report. You can do that for free at annualcreditreport.com. So if you want to make sure that you're accurately counting your current monthly debt, you can go pull your credit report and see how your creditors are listing your minimum payments. Okay? Now, let's talk about what we came here for. This is how you actually pre-qualify yourself. So steps 1 through 4 was gathering all the information. Step 5, we're going to go ahead and get this pre-qualification done for ourselves. So first thing, step A, we're going to subtract our current monthly debt from the total allowable debt that we got from step 3. So go back to step 3, whatever number you came up with there, you're going to take that number and subtract your current monthly debt from it. Now, a couple things. If you end up with a negative number, then you might be in trouble. But if you come up with a positive number, definitely keep that in mind. And when we go into an actual example, you'll see how this all fits together. All right, so the amount that's remaining is the amount that will be allowed for your monthly mortgage payment, generally speaking. Okay, it's going to make sense when we go through the example. Okay, now let's go through the example. Okay, we got our income, right? We understand how to calculate that. We know what the lender would consider allowable for a mortgage payment. We also understand what the lender would consider allowable for our total debt every month, right? We know what our current monthly debt obligation is. And now let's talk about getting the pre-qualification done. Okay, and this is an example. In this example, we're going to say we have a yearly gross income of $60,000, right? Now, the monthly breakdown of $60,000 for a year divided by 12 months is $5,000 per month. Okay. Now, based on what we just went over as far as calculating the income, right? And coming up with what's allowed for the mortgage payment, right? Which we did in step 2. We're taking 5,000 times 33%. It gives us 1,650. Okay. Now, we're going to do step 3. What's the allowable total debt we can have with our mortgage program? So 5,000 a month times 45% gives you $2,250. Again, because this is what they're allowing in total monthly debt payments, including the mortgage. Okay. Now let's continue. In this example, I'm saying that the current monthly debt for loans, credit cards, lines of payment, etc., is $700. Those are our total debt obligations, not including a mortgage, because we're either selling the home we currently have or this is our first home, so we don't have a mortgage. So the debts that the lender would calculate for our debt total $700 per month. Okay. So we're going to take the total allowed debt minus our current monthly debt, and we're going to get a total on that. And this is how you calculate that. So again, total allowed debt is $2,250. Our current debt is $700. That leaves us a difference of $1,550. Okay. So notice that in step 2, where we calculated the allowable mortgage payment was $1,650. The reason that we have a lower allowable mortgage payment is because our debt is higher. So once you take your total allowable debt and subtract what you currently have for monthly debt, it gives you what you're allowed to have. Now keep in mind, again, these are general numbers, okay? Your loan program may work a little different. They may allow a higher percentage for total debt. They may allow a higher percent for your mortgage payment. But this will definitely give you a general idea of how much you can get approved for when you go for a mortgage loan approval. And this is important to know so that you're not disappointed, surprised, or even confused, right? This gives you a general idea before you ever talk to a lender of where you stand. Now, this is the simplest way that I can tell you to do this for yourself. You can definitely go find calculators online where you can put in certain information. But if you don't understand the step-by-step process, you might input something wrong. And that's why I wanted to go through with detail on how you can do this for yourself. You may have to watch this video a few times. You may have to go back, pause, rewind, go through each step multiple times. But if you follow this, it'll give you a good idea of where you stand. And again, you won't be surprised when you go to the lender, and you'll be able to ask more questions, right? Especially like if you have debts that are soon to be paid off, you can ask that they can be excluded. Because sometimes if you just simply ask, you can get things that you want. So hopefully this brought a little bit more clarity. Amounts can vary by your loan program. I just want you to make sure you understand that, okay? Now, these were the 5 steps to pre-qualifying yourself. I hope this was helpful for you. Again, rewatch, like the video, share, subscribe, comment if there's additional information or other topics you want to see covered. Again, I thank you for watching this video, and I'll see you on the next one.